Adjusting entries. Let's take a closer look at how we do adjusting entries. Assuming that you already know about the basics about journal entries, let's look at why we might need to adjust those journal entries. During the end of an accounting period, we need to create financial statements in accordance with the company's performance. We need to ensure that these statements are up to date with the revenues and expenses that have been incurred throughout the year. We must first understand two principles that govern how we make adjustments to journal entries. Principle number 1, recognition principle. This states that revenues are recorded when they are earned. This principle states that only when we have earned the revenue is when we record it, not when payment is made, rather it is when it is earned or when the service has been fulfilled. The second principle is the matching principle. This principle states that expenses are recorded in the time period when they are incurred to generate revenues. The first type of adjusting entry is a deferred expense. These are expenses that have been paid in cash and been recorded as an asset before they are used or consumed. Let's look at an example. Suppose that $500 of office supplies are purchased by cash and recorded as an asset. Record the adjusting entry. Here, we would debit the office supplies expense of $500 and we would credit supplies for $500. However, if the office supplies were recorded as an expense, we could record that as supplies being debited for $500 and office supplies expense being credited for $500. The next one is deferred revenue. These are revenues are received in cash and recorded as liabilities before services are performed, also known as unearned revenue. Let's take a look at an example. Suppose Bill's gardeners receive $2,400 for their annual gardening services at the beginning of the year and is recorded as a liability. Record the adjusting entries for after 4 months. Here, we would debit unearned revenue of $800 and we would credit $800 service revenue. This is because after 4 months, a revenue income of $800 has been earned by Bill's gardeners. The next one is accrued expenses. This is when expenses are incurred first and paid for later. This includes such accounts as salaries, interest, rent, supplies, and many others. Let's take a look at an example. Harry's Burgers borrows $50,000 on the 1st of March for its new renovations in the kitchen. The annual interest rate on the loan is 5%, and interest is payable on the first day of each month. Record the adjusting entry for after 4 months of the borrowing date. Here we will debit interest expense for $1,000 and we would credit interest payable for $1,000. To work out how we do this is by using the simple formula of principal times annual rate times time. Our principal here is $50,000. The annual rate is 5% and the time that has passed is 4 months. Therefore, if you plug it in the formula, we get $1,000. So $1,000 interest expense and $1,000 for interest payable. The last one is accrued revenues. This is when a service is performed first and then the cash is collected as payment. The revenue is said to be accrued or increased. Let's look at an example. Suppose that Ryan's Mechanics agrees to service Joe's car for $250 fee. Ryan's Mechanics car services the car when Joe has dropped it off and receives payment for it. Then record the adjusting entries. We would debit accounts payable for $250